Hey, what's up everybody? In this video, by popular request, we're going to be having a look at Corsair Gaming. This is a smaller stock that a lot of people have expressed interest in, so let's have a look at it and see if it's a good deal. If you're new to the channel, I do a lot of investing and stock analysis videos, so if you're into that kind of thing, please hit the subscribe button so you can see more videos like this one. Alright, let's get started. Alright guys, I'm on Corsair's website. You can get a quick idea of the kind of businesses they're into. All kinds of, computers, gaming products. Anybody that does streaming, there's quite a few things for them as well. A lot of computer parts. So if you make your own computer, you want to custom make it, they do sell a lot of components. And what they're most known for, at least from my perspective, is their memory. But they got quite a bit more than just memory these days. Okay, so one of the reasons to be excited about Corsair and other gaming stocks is that, there's been a boom in video games during the pandemic. Now, from my own personal experience with video games, it's kind of a habit. It's something you get into. And it could be one of those things for a lot of people that really sticks, even post-pandemic. In other words, the lockdowns may have inadvertently created more gamers, which means more profit for companies operating in this industry. Alright guys, so here's Corsair stock. The company is currently trading at about 18.5 times next period's earnings. Their market cap is just about $3 billion, so it's a pretty small cap company, which leaves a lot of room for upside. I love to see that. Now, they don't pay a dividend yet, of course. They're still growing. The short interest really catches my eye here, above 20%. So more than 20% of the company's shares have been borrowed and sold short. So what does this mean? Well, short selling is kind of a double-edged sword. I mean, there's so many shares that have been sold short, the price is artificially being driven down. So if the short sellers are wrong, we could see a huge run-up in price as they're forced to liquidate their short positions. This is exactly what happened with Tesla stock in the fall of 2019. However, it is definitely riskier. Short sellers are not your everyday trader. They're typically hedge funds. They're very well informed. For them to be short selling a stock, it kind of indicates they have special information that the stock is overvalued. In addition, it's kind of a topic for another video, but these hedge funds are big players. They often know people in the media, and they're able to run kind of hit pieces, negative news stories on stocks that they're shorting. Let's have a look at Corsair's balance sheet. Leverage is pretty low, guys. Debt to assets ratio of just 22%. Liabilities to assets also not too high there. Liquidity, I don't see any major concern there. Current ratio 1.43. By the way, if you don't know any of these ratios, check them out in the description below. But quick ratio, just about 1. So they don't have any problem meeting their short-term obligations. They're not overly burdened by debt. The one ratio I think looks a little dangerous is that interest coverage ratio of just 7. So they can only cover their interest expense 7 times with the money they're bringing in. That's low. I want to see that higher. But I wonder if they're growing. If their income is expected to grow and they don't take on any more debt, that ratio will improve naturally. So we're going to have to look at their growth. But assuming they're growing, it's a great balance sheet. They're not too burdened by long-term assets either. Just about 46% of their assets are long-term. So really flexible company, not like bogged down by a bunch of factories. Got fairly low debt, nice liquidity, very nice balance sheet. Here's the revenue growth for Corsair, and it's pretty impressive, especially lately. From 2019 to 2020, we're seeing an increase in revenues from about 1.1 billion to about 1.7 billion. Very nice. And it continues to go up there, the trailing 12-month number, which that number includes 3 quarters from 2020. So I imagine in 2021 we're going to see even more growth. Now, like many growing companies, Corsair has struggled to make much money. If you look in red here, you got their operating profit margin. It was pretty darn low, and really they had a hard time getting it going. But in 2020, they reached 9.5%, and they're even increasing it further. It's about 11.2% most recently. Alright guys, so because Corsair is undergoing changes, they're growing, their cost structure is changing, I'm going to actually use the most recent quarter we have here, the quarter ending March 2021, to try and get a sense of what their profit margins are going to be. So if you look at this quarter, you got revenues of about $529 million. And what kind of net income do they generate off of that? Let's scroll down. And you see net income of about $46.7 million. So if we do the math there, that's about an 8.8% profit margin. If you're enjoying the content so far, please smash that like button. It really helps support the channel. Thank you. Now, before we estimate cash flows, we have to get a sense of the reinvestment needs of Corsair. In red, I have R&D expense, which is not a lot there. In blue, you got net CapEx, which is hardly anything. The company apparently doesn't need to spend much money on capital expenditures, at least not any more than they're depreciating them. And in green, we have acquisitions. So they made a big acquisition there, about $500 million in 2017. But otherwise, they're not spending a whole lot. You see about $136 million in 2019. We'll have to consider this as we estimate their reinvestment needs. Alright guys, so at this point in the video, it's time to use an intrinsic valuation model to figure out what is a fair price for Corsair stock. I'll be using the free cash flow to equity model. This model essentially says that the value of any stock should be equal to the present value of all the cash flows the company is going to generate. So I'm going to walk you guys through the process of how I'm going to estimate those cash flows. We're going to begin with analyst revenue forecast. Then we're going to estimate the profit margins and reinvestment needs. Let's walk through the spreadsheet. Alright guys, here's the path forward for Corsair. I use Seeking Alpha Analyst Forecast estimates of revenue. That gives me the next 3 years of revenue there. Now after 3 years, we don't have any data. Corsair is not big enough to have a big analyst following. So I'm left to my own estimations. I just have the growth tapering off a little bit, going from 9.4 down to 7, then down to 6, 5, 4%. If that's true, revenues are about $2 billion right now. They're going to be growing to about $3.3 billion in 10 years. Not that crazy to assume. I think that's reasonable. Now, profit margins, because they're changing, I'm not going to use a historical margin. I'm going to go with 8.7% based on the most recent quarter we have available. Then I'm going to assume they can increase those margins as they have been. And they're going to be growing a little bit every year, kind of topping out at 11.5% there, which is in line for the industry. So if they're able to get those margins, that gives me a stream of net income. The only step left is to subtract reinvestment needs. To estimate the reinvestment required, I'm going to use the sales to capital ratio. So given the capital they have invested right now, they're generating about $2.91 in sales for every dollar of capital. I'm going to assume that ratio continues. So as they grow their sales, for every dollar of sales they want to grow by, they're going to have to set aside a certain amount of money in reinvestments. And that's what you see here. So if all that is true, we have a stream of free cash flows. Let's see what the company is worth given these cash flows. Alright guys, so we know the cash on hand, we know the free cash flows for the next 10 years. The only thing left is that terminal value. Remember, the terminal value just takes the cash flow in that 11th year, divides it by the discount rate, minus the perpetual growth rate. So we're just basically assuming we can grow cash flows at some kind of perpetual rate. I've plugged in 1.5%. I'm being a little conservative there. Just assuming they can continue to increase their cash in line with CPI inflation numbers. If this is all true, guys, we have a total firm value of, depends on the discount rate you want to pick. So I'm showing you the fair price of the stock for anywhere from a 7 to a 10% discount rate or required rate of return. If you want a 10% return, the stock is very close to being fairly valued right now, which means you can estimate that you'll earn a 10% return with it. Given the safety of their balance sheet, even a 9% return or an 8% return would be fair. In that case, it's pretty darn undervalued. Alright guys, final thoughts on Corsair. I like it overall. I mean, the intrinsic valuation analysis is where I put the most weight in my analysis. And by that metric, it's definitely a good deal. The balance sheet is not overly risky, to say the least. It's actually quite solid. They're operating in a booming industry, so it's always a good place to be. That being said, the stock does have risks. Smaller stocks are always more volatile. They always have big price fluctuations. I just made this video today on May 10th, and the stock is down 5 or 6% in one day. So you got to keep that in mind. The other thing is the short interest. This is a big risk. You really got to think about this. When you short sell, you're exposing yourself to unlimited downside risk. These hedge funds are very sophisticated. They have insider information a lot of times. For them to short sell, when you see 20% short interest, that's a big red flag to me. And I'd think twice before betting against them. Even when on the surface all the numbers look wonderful. It's something you have to think about, and I'm really not sure what I'm going to do at the end, which means I usually don't buy, but it is definitely a stock worth thinking about. It could be a really great deal. Let me know what you guys think in the comments below. Thanks for watching.